In 2008, millions of people watched their retirement accounts fall sharply in value. And then, at the exact moment markets were near their lowest point, they sold everything. Not out of stupidity. Not out of panic, exactly. Out of a cognitive pattern so deeply wired into the human brain that neuroscientists have been studying it for decades. This video explains what that pattern is, where it originates in the brain, and how to catch it before it catches you. It is called the recency bias. And it is not a character flaw. It is a feature of how the human brain processes information and makes decisions under uncertainty. The premise is straightforward: when we evaluate a situation, we do not treat all available information equally. Recent events carry disproportionate weight in our judgment. A loss last week feels more real than a gain from 3 years ago. A crash last quarter silently reshapes expectations for the next decade. Kahneman and Tversky, whose work on decision-making under uncertainty earned a Nobel Prize, documented how human beings systematically deviate from rational prediction in consistent, patterned ways. Their 1979 research introduced prospect theory, the finding that people weight losses more heavily than equivalent gains, and that the framing of information profoundly shapes the choices we make. Recency bias operates in exactly this space. It is the cognitive machinery that determines which information gets promoted to the top of your decision stack, and which gets buried beneath the weight of events that happened longer ago. By the end of this video, you will understand the neuroscience behind that machinery, why conventional investment advice consistently underestimates it, and what the research suggests about building a more calibrated decision process. B-roll CUE, MRI brain scan, hippocampus region highlighted in warm color. Let us begin with the biology. James McGaugh, a neuroscientist whose research focused on memory consolidation, identified specific brain structures as central to how recent information gets encoded and retrieved. The hippocampus plays a crucial role in the recency effect. Recent experiences are more neurologically accessible, more vivid, and, critically, tend to feel more representative of current reality than older memories do. Camera change. But the hippocampus does not work in isolation. The prefrontal cortex, the brain's executive center, is involved in weighing recent information against longer-term context. When we are in a calm, analytical state, the prefrontal cortex moderates the pull of recent memory. When we are under stress, when markets are falling, when a decision feels urgent, that moderating influence weakens. The balance between these systems shifts. B-roll CUE, close-up of a person's face, expression of concern, looking at a screen with falling numbers. Antonio Damasio's work on the relationship between emotion and decision-making adds a further dimension. His research on the neural basis of emotional experience suggests that emotionally arousing events leave stronger cognitive impressions. They become more available when we attempt to make forward-looking judgments under uncertainty. The emotional weight of an event does not just make it feel more important. It makes it more likely to surface as evidence. Camera change. Alan Baddeley's comprehensive research on human memory describes the recency effect, our tendency to better recall and give more weight to recent items, as a fundamental feature of how memory architecture operates. It is not an anomaly. It is the system functioning as designed. B-roll CUE, prehistoric landscape, early humans moving through natural environment at dusk. That design made sense. The brain evolved in environments where recent information was typically the most reliable signal available. If a predator had appeared near a particular location last week, that location was dangerous now. If a water source had dried up recently, finding a new one was the immediate priority. Recency was not a distortion, it was a proxy for relevance. In modern financial markets, where the design of returns explicitly decouples recent performance from future results, that same signal becomes systematically misleading. Camera change. If this kind of evidence-based analysis is what you are looking for, consider subscribing. This channel publishes research-grounded content on behavioral economics and decision science on a regular cadence, no motivational framing, no guru positioning. Just the science, cited. Graphic, Timeline of Behavioral Finance Research, 1979 through 2008, key papers marked. Now let us look at what happens when recency bias meets financial markets at scale, and what the research actually documented. In 1985, economists Werner de Bont and Richard Thaler published research that has since become foundational in behavioral finance. What they found was that stock prices overreact to new information. When a company delivers unexpectedly strong results, prices often rise beyond what the fundamental change alone would justify. When news is negative, prices often fall further than the underlying reality warrants. The overreaction, they found, is systematic. Camera change. Crucially, de Bont and Thaler found that these overreactions tend to correct over time. Stocks that fell most sharply, driven in part by investor overreaction to recent bad news, often subsequently recovered. Stocks that rose most dramatically on recent momentum often corrected. The overreaction creates the conditions for its own reversal. B-roll CUE, graph showing price overreaction and subsequent mean reversion across a multi-year period. What this indicates is that recency bias does not only distort individual decisions. It moves markets. When enough participants weight recent events too heavily, asset prices themselves become distorted. Those distortions create the conditions for reversals, which then trigger the next wave of recency-driven reaction. The bias is not a personal failing playing out in isolation. It is a market-level structural pattern. Sound effect, low, subtle trading floor ambience, distant, not dramatic. Robin Hogarth and Hillel Einhorn's research on belief updating adds a structural dimension to this. Their work developed a model describing how people revise beliefs in response to sequentially presented information, and found that the order in which information arrives influences how it gets weighted in the final judgment. When information is delivered in sequence, as financial news always is, the most recent item exerts disproportionate influence on overall assessment. Camera change. Put directly, the last piece of financial information you encountered shapes how you interpret the next one. Financial media is, by design, a continuous stream of the most recent data, structured for engagement, not for calibration. Research in this area suggests that investors who consume the most financial news may carry the highest recency bias exposure, not the lowest. More information does not automatically produce better judgment. It depends entirely on how that information is weighted. B-roll CUE, financial advisor presenting performance charts to client, professional office setting. The standard response to cognitive bias in financial planning is familiar: diversify, think long-term, avoid emotional decisions. These are not incorrect prescriptions. But they address the symptom without engaging the mechanism. Camera change. Telling someone to think long-term during a market correction is neurologically incomplete advice. The brain's recency mechanisms do not pause because a person has articulated a commitment to patience. Stress activates the same circuitry regardless of stated intention. The prefrontal cortex, the very region responsible for holding long-term perspective, is precisely the structure whose influence diminishes under emotional pressure. Unexpected stat, graphic showing prefrontal cortex versus limbic system activity under high-stress decision conditions. Richard Thaler and Cass Sunstein's work on how environmental design shapes decision-making suggests a more productive framing. Their research explored how changes in the conditions under which decisions are made, rather than attempts to persuade people to decide differently in the moment, can produce meaningfully different outcomes. The relevant intervention is not philosophical. It is architectural. Work by Fergus Craik and colleagues found that the recency effect appears more pronounced in older adults. Evidence suggests this may relate to age-associated changes in working memory and cognitive control. This is particularly relevant for the demographic with the most at stake in long-term financial decisions, people in or approaching retirement. Camera change. Conventional financial advice rarely accounts for this variation. A framework built on the assumption that all clients operate under identical cognitive conditions is likely to systematically underserve the people most exposed to recency bias effects. Camera change. But here is where the research becomes genuinely actionable, and where it diverges most sharply from conventional advice. Because a precise description of the mechanism points directly toward a specific type of intervention. Not willpower. Not philosophy. Architecture. And the distinction matters enormously. Graphic, three-part framework, temporal distance, extended reference window, outside view. First, create temporal distance before consequential decisions. Kahneman and colleagues have extensively documented how analytical decision-making improves when deliberation is separated from the moment of peak emotional activation. The practical application is pre-commitment, establishing decision rules before emotionally salient events occur, before a market correction, before a dramatic rally. When the rule is constructed in advance, the moment of highest recency influence is removed from the decision itself. B-roll CUE, person writing carefully in a decision journal, calm morning environment, natural light. This is not the same as ignoring recent information. It is building a process that accounts for recent data without allowing it to function as the dominant frame, which, absent deliberate design, it typically will. Camera change. Second, systematically extend the reference window. If you are evaluating an investment decision based primarily on 12 months of performance, you are working from a data set structurally biased toward recency. Research in this area suggests that deliberately expanding the reference frame, to full economic cycles, to 10 or 20-year periods, does not eliminate recency bias, but it dilutes its relative weight. Recent data becomes one input among many, rather than the organizing frame for all interpretation. B-roll CUE, long historical market chart on a computer screen, spanning multiple decades, small fluctuations visible in long-term upward context. Third, seek an outside reference before committing. Kahneman and Dan Lavallo's work on risk and decision-making explored the distinction between inside view and outside view thinking, and research in this space suggests that outside perspectives, whether structured advisors, pre-agreed frameworks, or base-rate historical data, can provide a counterweight to judgment dominated by recent, emotionally vivid information. The outside view anchors assessment to distributions that extend beyond whatever happened most recently. Sound effect, low, resolved tone, signal of conclusion approaching. Hogarth and Einhorn's model of belief adjustment indicates that this bias in sequential information processing follows predictable patterns. That predictability is important. It means the bias can be anticipated, and decision architecture can be constructed around it. Camera change. Effective recency bias mitigation, the research suggests, looks less like individual discipline and more like institutional design. Rules made before events. Pre-commitments that do not require in-the-moment willpower. Structured review processes that compel recent information to compete with longer-term data on equal terms, rather than allowing recency to quietly dominate by default, which is what happens in the absence of deliberate structure. Recency bias is not a flaw in your judgment. It is a predictable, neurologically grounded feature of how the human brain encodes, retrieves, and weights information, one that becomes a liability in environments defined by long data series, compound returns, and market cycles that unfold across years and decades rather than days. The research from Kahneman and Tversky, from de Bont and Thaler, from McGaugh, from Hogarth and Einhorn, does not offer a cure. It offers something more practically useful, a precise description of the mechanism. And a precise description of a mechanism is the necessary prerequisite for building systems that account for it. Graphic, end screen overlay. If this is the standard of analysis you want consistently, evidence-based, research-grounded, without motivational packaging, subscribe. New content on behavioral economics and cognitive decision science publishes on a regular cadence. There is also a closely related cognitive pattern worth understanding next. It interacts directly with recency bias and shapes how you interpret the very information you use to make decisions in the first place. That video is right here. Point to end screen card position.